inflation news as well, so let's get right to the floor show. Joining me now, Miramar Capital founder and senior portfolio manager Max Wasserman and Great Hill Capital chair Tom Hayes. Tom, what does the erratic trading today signal for next week? I mean, we've got green on the screen for the Dow and the S&P. NASDAQ still slightly down. Russell has been flagging here, but now it's up about 7 points. So can we transport ourselves to Monday?
Yeah, well, you know, the genie's out of the bottle, Liz. The Fed tightened to the point where things are breaking, and the way to put the genie back in the bottle, they're going to have to do some type of a deposit backstop or increase the insurance, because the regional banks are having trouble raising capital when they don't know what their deposit base is going to be in 4 or 8 weeks. So I think maybe as we're going into a weekend, maybe it brings back 2 weeks ago when you had the lending facility come out over the weekend and the market rallied after that. So maybe people are anticipating something's going to get done over the weekend, because while it would take too much time to go through Congress, the executive branch can act unilaterally in times of crisis. So we'll see what happens. Yeah,
you're right to say watch over the weekend. We haven't said that since, I guess, before March 10th. But now, because of what happened with Silicon Valley Bank, Max, we have seen so many gyrations and problems and headlines. I mean, Credit Suisse was just bought by UBS. So the European banks are really struggling right now. You could sniff a little bit of contagion here. You feel that the most important task right now is still for the Fed to pounce on inflation. Here's the issue. We just got new inflation numbers, and that would be the S&P flash manufacturing flash report. And that came in a little hot, didn't it? So what do you expect the Fed to do?
Well, thank you for having me on. I think the Fed is going to be pressured to stop raising interest rates when I think they still need to. The biggest concern we have is that you have a stagflation period. We have the U.S. economy growing, let's say 0 to 1, 0 to 2, and inflation still running 5 to 6%. Long term, that is worse for the markets. While you have a banking issue going on, and I'm going to call it an issue, because in the U.S., you have the ability of the Federal Reserve and Congress and Janet Yellen to basically guarantee these deposits and take the pressure off. This was just bad management by banks to mismatch their duration. So we think the real issue is a commitment to stomp out inflation. And many people have not seen the effects of inflation. I mean, most money managers, analysts, and everybody's experienced a long time of cutting interest rates. So if the market can't handle a 4 to 5% treasury in this economy, then we got a bigger problem.
Yeah, I know, but listen, investors cannot figure out exactly what the Fed is going to do minute by minute, although the Fed funds futures are showing that there's going to be a pause at the May meeting. So, Tom, if we do see that pause, or if we don't, because, again, we have no idea, give me a sense of where you put the money right now if you're looking to spend some on equities, at least names that have pulled back.
Yeah, well, one we like has been completely left for dead, Liz, and that's PayPal is down 75% from its pandemic highs. But here's the news. They're trading at 13 times next year's earning. They're growing earnings at 15%, and management has compounded capital, return on invested capital, at mid-teens for the last half a decade. So even if margins compress a little bit with a slowdown, we do think the nominal ticket's going to be higher because inflation's going to run probably 3 to 5% for the next couple of years.
Well, that, again, is the way that some very smart traders like Tom look at this and say, well, let's find things that have been totally beaten down. What about you, Max? I mean, you've got some names that I want our viewers to hear because you have some very interesting ideas that propel that pick.
Yeah, so, you know, there's 3 areas that we're emphasizing today. Is we'd still like energy. A company like Chevron that's paying a 3.9% yield, trading at 10 times earnings. They're buying back roughly 20% of their market cap over the next 5 years, and they have less than 20% debt. So Chevron has a tremendous balance sheet. They're in great shape, and we think for the long term, it's a good investment. Yeah. We also like defense. You know, in this uncertain times, you have a company like General Dynamics. They produce nuclear subs, the Abrams tanks, and 20% of their business is Gulfstream private jets, and we think that's a very strong area for them. They're trading at roughly 17 times, 10% dividend grower, at 2.4% dividend yield. So that gives you an exposure to defense and industrials. And our third one is we like AbbVie. We like healthcare. You're having a company trade at 13 times earnings, 3.8% debt. I'm sorry, 3.8% dividend yield. And the company's in great shape. It's coming off Humira, a patent, but they have a lot of other drugs like Skyrizi and Rivcon that are coming in there. So we like those areas. Again, but we're looking not for the next 3 to 6 months. We're looking for the next, let's say, 1, 2, and 3 years. And we think these are good investments. For people who are really nervous about the short term, money market, short-term treasuries is not a bad place to be. If that's what your concern is, your time horizon short, then I would stay short.
Yeah, I'm looking at the Treasury yields right now. Keep in mind, everybody, that yesterday the 2-year tumbled to a 6-month low of about 3.80%. And right now it's even below that to 3.75% for the 2-year. The 10-year is at 3.36%. And yesterday it tumbled to, I guess, below 3.5%. So that one's slightly, well, no, it too is considerably lower. So there is that flight to treasuries at the moment. People are not sure what's going to happen. So, yes, watch over the weekend. Good to see you both. Tom, Max, thank you very much.